Welcome back. Today, we are looking at the nervous system of the electric vehicle revolution. While everyone focuses on Tesla or BYD, we are digging deeper into the chips that actually make those cars move, stop, and sense the world. We are analyzing Allegro MicroSystems, ticker symbol ALGM. We have combed through their financial filings from their IPO period in 2021, all the way to the most recent quarter ending September 2025. This is a story of explosive growth, a painful crash caused by inventory gluts, and a potential recovery that is forming right now. Let's start by defining what Allegro does. They are the global leader in magnetic sensors and a major player in power management, ICS. Essentially, their chips measure speed, position, and current. Without these chips, your electric car's battery management system doesn't work, and your robotic arm doesn't know where it is. Our journey begins in fiscal year 2021 and 2022. This was the golden era of the semiconductor shortage. In the 2021 and 2022 1OK filings, we see a company firing on all cylinders. Revenue jumped from roughly $590 million to over $760 million. The narrative was purely about e-mobility and clean energy. Every car maker was scrambling to buy chips, and Allegro had strong pricing power. They were heavily investing in capacity, convinced that the demand curve would only go up. The automotive sector accounted for nearly 70% of their sales, making them a pure-play bet on the electrification of cars. Moving into fiscal year 2023 and 2024, the momentum continued, but clouds started to gather. By the end of fiscal 2023, revenue hit a record $973 million, crossing the billion-dollar run rate shortly after. Gross margins expanded to impressive levels, hovering around 55 to 57%. However, if you look closely at the 2024 1OK, you start to see the cracks. The industrial segment began to soften. Why? Because during the shortage, customers panicked and double-ordered. Now they had warehouses full of Allegro chips and stopped buying. This is what economists call the Bullwhip effect. Then came the crash of fiscal year 2025. 10K for the year ending March 2025 is a sobering read. The automotive market, which was their fortress, finally cracked under the weight of excess inventory. The transition to EVs slowed down globally and legacy auto manufacturers cut production. Allegro's revenue growth stalled, and for the first time since their IPO, investors faced a shrinking backlog. The stock price reflected this fear, dropping significantly from its highs. This brings us to the present, fiscal year 2026. We have analyzed the 1OK reports for the first 2 quarters of fiscal 2026. Ending in June and September 2025, the data suggests we are bouncing along the bottom. In the second quarter of fiscal 2026, revenue came in at $187 million. This is a sharp decline compared to the $275 million they generated in the same quarter a year ago. That is a drop of over 30%. The inventory correction is brutal. However, it is not all bad news. There is a new growth engine emerging in the filings. AI data centers. You might wonder, what does a car chip company have to do with AI? The answer is cooling. AI servers generate massive heat and require powerful liquid cooling pumps and fans. Allegro's motor driver chips are perfect for these high-efficiency cooling systems. The filings highlight that while auto is down, the data center business is seeing strong structural growth. Let's look at the financials. Despite the revenue drop, Allegro has managed to keep its head above water. They are debt-free, which is a massive advantage in a high-interest rate environment. They have over $180 million in cash. This strong balance sheet allows them to continue investing in R&D even while their competitors are cutting costs. They are developing new magnetic current sensors for high-voltage EV chargers and solar inverters, positioning themselves for the next upcycle, but we must address the risks. The biggest risk found in the risk factors section is China. A significant portion of their sales is delivered to distributors and contract manufacturers in Asia. With ongoing geopolitical tensions and export restrictions, this supply chain is fragile. Furthermore, the EV winter, the global slowdown in electric vehicle adoption, is a direct headwind. If consumers don't buy EVs, car makers don't buy Allegro chips. So, what is the verdict? Allegro MicroSystems in late 2025 is a classic turnaround story. The financials show that the worst of the inventory correction is likely happening right now. The revenue has reset to a lower base. But the company remains profitable, debt-free, and technologically dominant in magnetic sensors. If you believe that the EV trend is just paused, not dead, and that AI data centers will need more efficient cooling, then Allegro is currently priced for pessimism. Watch the days of inventory metric in the next earnings report. Once that number starts to drop, the recovery will truly begin.